Hey guys, in this video, I'll be talking about the most anticipated SPAC, PSTH. I'll be covering what is a SPAC, what is the structure of PSTH, what are the potential targets, as well as my full recommendation. Stay tuned. So someone told me recently they don't like my intro, which I'm like, I think it's cute, I think it's fun, but if y'all not into it, I guess I'm not married to it. I'll consider changing it. But anyway, let's talk about the SPAC. So first of all, what is a SPAC? A SPAC is a special purpose acquisition company, and its whole purpose is to merge with a private company and make that company public. So basically, there are two ways a private company can go public. They can either do a traditional IPO, and I have like a whole video explaining how all that works, or they can do a SPAC. Reasons why a company might choose to do a SPAC over a traditional IPO is that it honestly avoids all the hassle it takes to do a traditional IPO, and also a lot of times companies don't have, they just don't meet the requirements, or maybe they don't have the proper finances or whatever the case may be. In 2020, we saw a record number of SPACs. I believe 2020 had the most SPACs in history, and a lot of those SPACs were made for the EV companies to go public. We saw Nikola that went public through a SPAC. Most recently, we saw Quantum Space that went public through a SPAC. So it's a very popular thing to do in the EV space. The thing about SPAC is when you buy a SPAC, you don't know what company they're eventually going to merge with. So you're pretty much buying into the hope and aspiration that they're going to merge with something good. So this is a scenario where you really have to bet on the jockey, if not the horse. Which brings us to the jockey of PSTH, Bill Ackman. So Bill Ackman is actually a very well-known hedge fund manager. As a matter of fact, his first SPAC actually brought Burger King public, and most recently he made headlines by turning $26 million into $2.3 billion because he shorted the market right before the whole Rona frenzy. And I believe last week there was an article that stated that his hedge fund had a 70% return for 2020, which is pretty significant. However, we all have had our losses, and I think in this instance it's important to talk about his biggest loss, which was Herbalife. He lost like $1 billion shorting Herbalife. But honestly, in his defense, Herbalife is a scam. I'm sorry if your auntie lost a bunch of weight and now sells Herbalife. Like, it's a scam. So I probably would have shorted Herbalife too. The only difference, I think, he was very stubborn about it. I think he started his position in 2012 and he didn't close out till like 2018. Like, I would have taken the L much sooner than that. So there's that. All right, so let's talk about the most exciting part here, which is PSTH and its structure as a whole. So PSTH stands for Pershing, let me make sure I get this right. So PSTH stands for Pershing Square Tontine Holding. It is a $4 billion SPAC with the option to be a $7 billion SPAC, making it the largest SPAC in the whole history of the world. The net asset value is $20, which is very different from typical SPAC that usually starts at $10. You get 2 ninth warrants, meaning that for every 9 shares you have, you get 2 warrants. So for example, if you have 99 shares, that means you get 22 warrants, which you can exercise at a $23 strike price. For those of you not familiar with warrants are pretty much similar to call option. The only difference between a warrant and a call option is that when you exercise a warrant or when you buy a warrant, you're pretty much buying it from the company itself and not necessarily from another trader. Let's talk about the name specifically. Pershing Square Tontine Holding. What does Tontine mean? An annuity scheme by which several subscribers accumulate and invest a common fund out of which they receive an annuity that increases as subscribers die until the last survivor takes the whole. All right. No one's gonna die, okay? Basically what that means is there is a limited amount of warrants. I believe it's 400 million warrants outstanding. So if people sell their shares before the merger happened, they're essentially forfeiting their warrants, which puts it back into the pool. And that means, because now there's more into the pool, that means there's more for you. So instead of getting 2 9th warrants, you can perhaps get 3 9th or 4 9th, and so on and so forth. So that's what that means. So no one's gotta die. So aside from this SPAC being backed by a well-known hedge fund investor, Bill has done a really good job with the board of directors that he has put on the SPAC. The first one we have is Lisa Gersh, who is a co-founder of Oxygen Media. The other one is Michael Ovitz, which is a former president of Walt Disney. We have Jackie Reese's, a former head of Square Capital, parent company of Cash App. And then we have Joseph Steinberg, which is a former chairman of Jefferies Financial Group. So that's a pretty all-star team, particularly Jacqueline, which we'll talk about more when we talk about potential target companies, and you'll see why I think her presence make a difference. So if we look at the current investors for this SPAC, you can see the biggest investor is Guggenheim, who has invested over $500,000 at the time. And Guggenheim is actually a pretty large investment management firm with about, I believe, $295 billion in assets. So these are huge. All right, so we know what is a SPAC. We know who's behind the SPAC. We know what is the structure of the SPAC. Now, let's talk about potential companies that Bill might be targeting. So one thing Bill has made very clear is that he's looking for a mature unicorn. He's looking for a company that's already well established, and he's potentially looking for a company that is family run. So those are our main 3 criteria that he's looking for. So with that in mind, there is a couple of companies we can consider. And I think the first one is pretty much the one that everyone is just hoping for. There's a lot of cult following for this. Me personally, that's what I'm also hoping for, but I'm just not as confident as some people on the internet seems to be, and that company is Stripe. Stripe pretty much meet all the criteria. First of all, it is a unicorn. It's well established. If you're not familiar with Stripe, it's a payment platform. You've probably used Stripe and not known you use Stripe. And third, it is family run. The CEO and co-CEO, I believe, are 2 brothers, the Collision brothers. So it definitely meets the criteria. However, even though the world wants it to be Stripe, a few months ago there was somebody on Twitter that was like, that tweeted at one of the brothers and was like, "Congratulations on your deal with PSTH," and they pretty much was like, "There's no deal." I'm a person that likes to take things at face value. If they say there's no deal, I'm inclined to think there's no deal. But just because they said there was no deal right then and there doesn't mean they weren't considering a deal, especially when you take into consideration that Stripe has recently posted a lot of job openings for SOX compliant roles, and I can tell you right now, as a person that has to consider SOX compliant as her day-to-day job, you only concern with SOX, being SOX compliant, when you are a publicly traded company. Like if you're a private company, doesn't matter. So the fact that they're looking for people that have that kind of experience tells me they are going to go public. Now, whether or not they're going to go public via SPAC, PSTH, or any other, or they're going to go public the traditional way, I have no clue. But Stripe is going public. So finger crossed they go public with PSTH. So the other one we have is Bloomberg. I don't know if I would consider Bloomberg a mature unicorn. It's more like a mature dinosaur, to be honest, but it is family run. It is owned by Bloomberg. Mike Bloomberg, you might have known him because he ran for president. So I guess I can see it. I think the market would be okay with that. I don't see the market being as confused as they would if it were Stripe. But Bloomberg is fine. I would be fine with Bloomberg. But then again, Bloomberg is one of those situations where like Mike Bloomberg has expressed like he doesn't have an interest with going public. So all of these are just speculation, folks. Like there's always like an argument for one, but then there's also like an argument for like the opposite too. So all speculations. And the third one that the internet seems to think is true is Chick-fil-A. Now, I see why they would feel like it might be Chick-fil-A because, well, Bill has experience with food industry. Chick-fil-A is, I don't know if it's a unicorn, but Chick-fil-A is well established. Chick-fil-A is family run. However, the main purpose for a private company to go public is to raise money, to raise capital. And if you've ever been to Chick-fil-A, then you know Chick-fil-A, it is not strapped for cash. On top of that, Chick-fil-A is family run, but they are a very, 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 very conservative family. I think a few years ago, I looked into what it would take to buy a Chick-fil-A franchise. And first of all, you have to be a Christian with a proven attendance record of going to church. And I just don't see Bill Ackman as that person. I just don't see Chick-fil-A willingly giving up 15 to 20% of their company to anyone, never mind Bill Ackman. So that's a dub. The fourth one that people are throwing around is Starlink, which is a company by Elon Musk. While I'm all in favor for that because anything Elon Musk touches turns to gold, so I'm here for it. I just don't see it. I mean, Elon has expressed that he would go public with Starlink, but the thing is, Starlink is not a unicorn. So I don't see Bill being interested in Starlink at all. So there's that. All right, so what is my recommendation? All right, before I tell you guys my recommendation, and I have like 4 different ones, so definitely stay for that. I'm going to tell you guys why I purchased PSTH, what has changed since then, so that way you can make your best informed decision. So I bought into PSTH 3 weeks ago, and I bought at $25 a share. At that point, I felt like it was a good investment because the downside was capped at the NAV, which is $20. So basically my risk was the price that I paid to the NAV. So basically I bought my shares at $25 and the NAV is $20. So that means I was risking $5 a share or 25%. And I felt like risking 25% for potential of 50 to 100% increase in my investment was worth the risk. In addition, Bill Ackman is a very notable investment hedge fund manager, so I felt safer with that. But now it's slightly different, and this is not me leading to don't buy this. This is me just explaining what's different. And now that PSTH, let me just double check real quick. So now that PSTH is trading at about $29 a share, that means your risk is about 45%. And depending on when you're watching this video, the price might be different, but the way you calculate that is to take whatever the price it is at, so say 29, minus 20, divide by 20, which will give you a percentage. Well, you have to multiply by 100 to give you the percentage, but you get the point. So I guess at that point, you can decide whether or not, say 45% is okay with you. At that point, you might decide if things go sideways and this doesn't work out, am I willing to lose 45% of what I've put in? Again, like I've said, when you're buying a SPAC, you're buying hopes and aspiration, you're pretty much buying a mystery box. So you kind of have to like do that calculation and decide for yourself if that percentage is okay with you. The other thing you can do if you don't want to buy common shares, because perhaps the percentage of loss is too high. What you could do is buy options. You can buy call options. What I've noticed with SPACs is no matter what, once announcement happens, the SPAC will go up to like 30 to 50%, so you can still make money. So Bill has expressed that he is going to announce in Q1, so it might be like literally today, it might be in March, we don't know. So if you're going to buy call options, I think the safest bet is to buy a June call option. I believe it's June 20th or something like that. So just to buy a June call option, I would preferably buy in the money. So I would buy like a $25 call option, just to be on the safe side. Third thing you can do, instead of buying PSTH, which is the SPAC, you can buy Pershing Square Capital Management, which is the hedge fund that Bill's managed, and that has a lot of PSTH. So that way, if things go right, you will still benefit. If things go wrong, then you're not directly that impacted. So these are my 3 options for you. In general, I'm actually very excited about this SPAC. This is the first SPAC I've ever invested in. And I hope that it works out. I think I've covered everything. If I didn't, if I forgot something, I'll put it in the description, so definitely check that out. Other than that, thank you for watching, and I will see you on the next video.